Hey, today, let me tell you about Larry Williams, a guy who knows his way around trading. He took $10,000 and turned it into $1.1 million in just a year. That's like a crazy 11,300% increase. Now, if you're anything like me, you're probably wondering, how on earth did he do that? Well, I went snooping around the internet to find out the simple strategy he used to make those huge gains. Oh, buckle up, because I struck gold. I discovered the precise trading plan Larry Williams used to pull off those incredible gains. Let me tell you, Larry deserves major props for coming up with this, because it works like a charm. And guess what? I'm spilling the beans with all of you. Let's dive right in. The strategy behind those massive gains is none other than the LW volatility breakout strategy, LW standing for Larry Williams. Pretty straightforward, right? This strategy revolves around a key indicator called the Donchian channels. To add it to your chart, head over to the Indicators tab, type in Donchian channels, and select the appropriate option. Now, the Donchian indicator is good on its own, but to make it work the way we want, let's tweak some settings. Go to the indicator settings and change the length to 96. Next, head to the Styles tab and switch the line colors to red for better visibility. Here's a crucial detail. These settings are tailored specifically for the 5-minute time frame. Larry specifically used the 5-minute time frame for this strategy. If you're opting for a different time frame, it's advised to conduct your own testing with various indicator values. Now, let's take a look at the Donchian channels indicator on its own. It comprises 3 lines. The middle line serves as a mean reversion point for the market, acting like a magnet that attracts the price. This line can also help gauge the momentum of the chart. If the price is above, it's bullish. If below, it's bearish. Moving on to the upper and lower bands, these act as great support and resistance levels. Often, the price will hit these bands and bounce back. The upper and lower bands can also serve as breakout points. If the price breaks the upper band, there's a good chance it will continue heading upward, exactly how Larry employed it. But here comes a bit of foreshadowing. There's a catch to this strategy. Actually, it's more than a small problem. Let me break it down. Typically, you'd enter a long position when the price breaks the upper band, set your stop loss just below the middle line, and target a take profit that aligns with a 2-to-1 risk-to-reward ratio, securing a winning trade. However, here's the hiccup. If the market is consolidating and moving sideways, that's when issues with the strategy start cropping up. When the market is consolidating, the upper and lower bands tend to be very close together, like what you see here. This proximity makes them more susceptible to breaking even with a small move that lacks substantial momentum. In the end, this could lead to a false signal, resulting in a losing trade. To avoid this scenario, we need to find a way to filter out such low-quality trades and focus on those with significant movement. To achieve this, we'll introduce 2 more confirmation indicators. The first confirmation indicator we're incorporating is the LWTI, short for the Larry Williams Large Trade Index. Now, let's tweak the settings for the LWTI indicator. Change the period to 25. The higher this number, the more it focuses on long-term trends. If you're seeking confirmation for shorter-term trends, a smaller number is preferable. In my experience, 25 works best for the 5-minute time frame. Additionally, adjust the smoothing period to 20. For the final touch, let's add a simple volume indicator. I know, not the most thrilling, but it'll be a game changer in avoiding false signals. Adjust the moving average length to 30 in the settings. Head to the Style tab and activate the volume moving average, setting the color to white. This volume indicator will be invaluable in identifying when the market is truly backed by momentum and not just experiencing a small, insignificant move. Now, let's get into executing this strategy. Make sure you're on the 5-minute time frame. For a long trade, follow these steps. Step 1. Wait for the price to rise and touch the upper red line. Step 2. Ensure that the LWTI indicator is green. If it's red when touching the upper band, skip the trade. Step 3. Confirm that the volume bars are above the white line and also in green. This indicates that the market isn't consolidating and there's sufficient volume to justify entering the trade. And here's a little extra for you. Stay tuned until the end, and I'll share the secret trick to enhance the strategy's performance. All 3 criteria must align for you to enter the trade. Once they do, that's your signal to enter. Now, let's talk about setting up your stop loss. Usually, you'd place your stop loss just below the middle orange line. However, there are situations where this isn't ideal. For example, when there's a significant gap between the upper band and the orange line. In such cases, setting your stop loss at the middle line would result in a huge distance. If that's the scenario, consider placing your stop loss at the recent swing low instead. However, in most cases, you'll be setting it just below the middle line. After setting your stop loss, establish your take profit at a 2-to-1 risk-to-reward ratio. And just like that, you've got yourself a potentially profitable trade. Let's walk through a short example. First, wait for the price to touch the lower band. Check the LWTI indicator. It should be red. Confirm that the volume is above the white line and the bars are red. Once everything aligns, enter the trade. Set your stop loss just above the middle line and establish your take profit at a 2-to-1 risk-to-reward ratio. And voila, you've secured another winning trade. Now, let's get into the secret trick. Another minor issue I discovered with this strategy is its performance near major support or resistance levels. Take this example where all our requirements were met. Indeed, the price touched the upper band, the LWTI indicator was green, and the volume was above the line, all signaling a trade entry. We set our typical take profit and stop loss. However, this trade turned out to be a loss. Zooming out, we can see that all criteria were met, but right at a robust resistance level. Despite getting all our signals, the price bounced off this strong level, resulting in a losing trade. To address this issue, here's the secret trick. Use a higher time frame, like the 1-hour chart, to identify major support and resistance levels. Once you've marked them, avoid entering trades close to these significant levels. For instance, in the trade mentioned earlier, you would have skipped it due to the strong resistance level. What I found effective is entering trades when the price is breaking a resistance level and all indicator requirements are met. This indicates strong confluence and bullish momentum in the trade. Now let's talk about the benefits of this strategy. The Larry Williams LW Volatility Breakout strategy comes with several benefits that contribute to its appeal for traders seeking a systematic and disciplined approach to day trading. Impressive profit potential. One of the most notable benefits is the strategy's demonstrated ability to generate substantial profits. Larry Williams' own success story, turning $10,000 into $1.1 million in a year, serves as a testament to the strategy's profit potential. Clear and objective entry and exit signals. The strategy provides clear criteria for entering and exiting trades. Traders can rely on specific indicators and conditions, such as the Donchian channels, LWTI, and volume bars to make informed decisions. This helps eliminate emotional decision-making and promotes a disciplined trading approach. Risk management. The strategy incorporates a 2-to-1 risk-to-reward ratio, emphasizing prudent risk management. By setting a stop loss and taking profit based on this ratio, traders aim to maximize potential gains while limiting losses, contributing to a more sustainable trading approach. Versatility across time frames. While Larry Williams used a 5-minute time frame, the strategy can be adapted to different time frames. Traders have the flexibility to adjust the settings based on their preferred trading horizon, allowing for versatility in application. Additional layer with higher time frames. The incorporation of a higher time frame for identifying major support and resistance levels adds a strategic layer to the approach. This can enhance the robustness of the strategy by avoiding trades near significant price levels, potentially reducing the risk of false signals. Quantifiable indicators. The strategy relies on quantifiable indicators such as the Donchian channels, LWTI, and volume bars. This mathematical foundation provides traders with measurable data for evaluating market conditions and making trade decisions. Educational value. The strategy offers educational value for traders looking to deepen their understanding of technical analysis and day trading. By dissecting and implementing Larry Williams' approach, traders can gain insights into market dynamics and the importance of adapting strategies to changing conditions. In conclusion, pairing this strategy with basic support and resistance, or even supply and demand, enhances its effectiveness. Thanks for tuning in, and I'll catch you guys in the next video. In the early 1990s, Wall Street was an exclusive domain, not easily accessible to outsiders. Business was thriving, but entry required not just skill but also prestigious credentials from top-tier institutions like Princeton, Harvard, or Stanford. Undeterred by the cutthroat environment, Kyle, armed with a shifted mindset, aspired to break into Wall Street, aiming for true financial freedom at any cost. Kyle Bass, the American investor and founder of Conservation Equity Management, a Texas-based private equity firm focused on environmental sustainability. He is also the founder and principal of Heyman Capital Management, LP, a Dallas-based hedge fund focused on global events. In 2008, Bass successfully predicted and effectively bet against the U.S. subprime mortgage crisis by purchasing credit default swaps on subprime securities, which, in turn, increased in value when the real estate bubble burst. In the beginning, everything was distinctly unusual. This wasn't the conventional start of an American dream tale with a white picket fence. Instead, it commenced with Kyle relying on prescription pills, even though he didn't actually require them. The root of this unconventional medication regimen lay in his mother's hypochondria and self-diagnosis expertise, akin to a medical infomercial evangelist. In an attempt to secure her son's well-being, she initiated a medication routine that inadvertently led Kyle to gain weight. Growing up in a lower middle-class environment where the family's financial struggles were evident in hand-me-down clothes and a daily dose of medication, Kyle's childhood set him apart from his peers. Fortunately, his father's role as a hotel manager in Miami offered a lifeline when the family relocated to Dallas, Texas, following a change in hotel ownership. Adjusting to a new environment, Kyle found himself yearning for change. And change he did bring about. Kyle defied the odds by discovering a passion for diving in Dallas, an interest that later laid the foundation for his success in trading. His relentless work ethic in diving earned him a scholarship, but despite his achievements in this arena, college failed to captivate him. The mundane subjects of chemistry, molecules, and anatomy left him yawning, pushing him to seek solace in the waters whenever possible. As he approached his junior year, faced with the choice of an elective, Kyle opted for something more exhilarating. A class titled Options and Futures caught his eye, stirring his latent curiosity about money. This marked a turning point as he delved into the world of finance, mastering the basics of bonds, stocks, and options. Finance became the book of revelations for Kyle, the key to escaping the shackles of a paycheck-to-paycheck existence. With newfound knowledge and a burning desire for financial freedom, Kyle dared to make a drastic decision. He switched his major to finance with a focus on real estate, defying the expectations of his parents and risking their disapproval. This decision marked the beginning of Kyle's journey into the world of finance, setting him on a trajectory to Wall Street. Overcoming the initial obstacle of mindset, Kyle secured a position at Prudential Securities, where he underwent rigorous training. The year-and-a-half spent at Prudential was a challenging yet invaluable experience, exposing Kyle to the intricacies of global trading. Recognizing the potential in hedge funds, Kyle seized an opportunity to explore this emerging industry, eventually earning an offer from Bear Stearns. With $2,500 in hand, Kyle embarked on a journey to Geneva, venturing into the world of hedge funds. His role at Bear Stearns began as a research analyst, delving into potential stocks and presenting his findings to a group of short sellers. Despite the grueling workload and long hours, Kyle's determination led him to excel, and he soon ascended to the position of senior managing director at the age of 28, making history at Bear Stearns. However, Kyle's thirst for greater achievements did not wane. With a burning desire to master finance and achieve financial freedom, he took a leap of faith. Risking everything he had built, Kyle founded his own firm, Heyman Capital Management LP, with $5 million of his own money and $28 million from investors. The pressure intensified as he faced challenges in building a reputation and managing other people's money. Launching a hedge fund proved to be an arduous journey, demanding a solid reputation. Kyle faced skepticism from investors due to his lack of iconic trades or historic performances. The pressure mounted as he struggled to maintain investor confidence, facing doubts about the sustainability of his fund. Undeterred, Kyle sought a game-changing trade that would not only save his firm, but also establish his reputation. In a moment of serendipity at a wedding in Spain, Kyle stumbled upon a conversation about synthetic CDOs, the catalyst for the 2007 housing market crash. Intrigued by the potential, he delved deeper into the complexities of these financial instruments, realizing the magnitude of the opportunity. Despite facing disbelief and resistance from investors, Kyle persevered, eventually identifying a fraudulent scheme at a California company named Quick Loan Funding. Armed with conviction, Kyle made the bold decision to short the housing market. Employing a risk-averse approach, he pitched the opportunity to investors based on low-risk, high-reward prospects. This strategic shift attracted more investors to his cause, enabling Heyman Capital to make a massive bet against the subprime mortgage market. As the trade unfolded, Kyle's team purchased credit default swaps, CDSs, against the subprime mortgage market, leading to substantial profits. The success of the trade not only saved his firm, but also garnered widespread recognition. Kyle testified as an expert witness before the U.S. House of Representatives and the Financial Crisis Inquiry Commission, solidifying his status as a financial maverick. Despite achieving monumental success, Kyle's journey was far from over. Motivated by a constant fear of inadequacy and a desire to prove skeptics wrong, he set his sights on the next big opportunity, the emerging markets of China and Japan. His research and analysis focused on predicting the financial landscape for the coming decade, showcasing Kyle's unwavering determination to stay ahead in the ever-evolving world of finance. As Kyle's story unfolds, the audience is left with a profound message about courage, resilience, and the pursuit of one's ambitions against all odds. His journey from a kid on medication to a Wall Street legend exemplifies the transformative power of determination and the ability to overcome challenges. The script reflects not just the financial acumen of Kyle Bass, but also the human spirit's capacity for growth and triumph in the face of adversity. Thank you for joining us on this extraordinary journey. We hope you found inspiration in the story of Kyle Bass, a true embodiment of tenacity and triumph. Remember to subscribe for more compelling content. See you in the next video.
City, this is Eric.
Give me Elliot.
City.
Hey, it's Will Emerson.
William, how are you?
I'm all right. How's the trouble and strife?
Busting my ass as always.
You see, that's why I tried to tell you, John. Why do you think I'm single?
I know you did.
The events that unfolded during and after the 2007 to 2008 financial crisis shed light on many fraudulent activities and conspiracies in stock markets worldwide.
Will continue on Wall Street.
Soaring gas prices, falling home prices, and rising unemployment.
It became evident that there were manipulations, insider trading, and other irregularities happening in share markets. Shares were being emptied, and a considerable amount of them were being sold off. Numerous such activities took place, and by the time auditors and regulators got wind of these issues, a significant amount of time had already passed. Despite the regulatory efforts, the stock market, even in today's scenario, is rife with rampant speculation and rule-breaking. In the midst of all these incidents, one trader has managed to stand out and break all the rules: Steve Cohen. He's not only made headlines, but has also earned not just millions, but billions in the bull and bear markets. Now, let's explore a trade that's garnered attention for its rule-breaking nature: the story of Steve Cohen's risky operations in the stock market. The narrative begins with Raj Rajaratnam, a highly known name on Wall Street. During the midst of the 2008 Lehman crisis, a handful of investigations were initiated against him. Federal agents were relentlessly pursuing Raj Rajaratnam, aiming to set an example that if anyone was engaged in insider trading or fraudulent activities, they would face consequences. Trading is not easy to escape once involved. Investigations were ongoing during this time, with federal agents interviewing prominent traders to determine their involvement. One name repeatedly came in conversations and discussions related to insider trading: Steve Cohen. Federal agents were perplexed, questioning why Steve Cohen's name consistently surfaced in connection with these activities. To understand Steve Cohen's story, we need to go back to his beginnings. Born in 1956 into a middle-class family in Long Island, New York, Cohen did not come from a wealthy background. Despite financial constraints, he showed a keen interest in finance from a young age. Fascinated by the markets, Cohen was sharp in academics, and he secured admission to a university in New York. While attending university, Cohen would read the Wall Street Journal every morning, determined to enhance his business skills. His passion for making money was evident from his childhood. After joining the workforce, Cohen engaged in two important activities. Firstly, he played poker, winning against friends and accumulating money. Secondly, he immersed himself in the financial world, driven by the desire to earn more. Cohen's financial aspirations led him to venture into the stock market. He combined his talents for speculation and gambling, amassing great wealth. However, there came a point when he realized that relying solely on speculation might not fulfill his ambitions. This realization changed everything for him. In 1978, at the age of 21, Steve Cohen decided to shift his focus from mere speculation to building a more substantial career in finance, a desire to achieve something greater. Steve Cohen, after graduating, joined a brokerage firm named Gruntle in New York. Despite the company's tarnished reputation due to alleged wrongdoings, Cohen utilized his skills to turn a profit. On his first day at Gruntle in 1978, Cohen earned a profit of $300,000, a significant amount at that time. But Cohen continued to refine his skills, eventually achieving extraordinary success. Within a span of a few years, he generated profits ranging from 60 to 80 crores in the volatile Wall Street market. His success was unmatched, leading to widespread speculation and curiosity about his trading strategies. The turning point came in 1985 when the Securities and Exchange Commission, the regulatory body, took notice of Cohen's activities. Despite skepticism in the market, Cohen's clear strategy involved options trading, and he was exceptionally skilled at managing risk and maximizing profits. When an attempt was made to investigate, it became evident that there was significant discrepancies. There comes a controversy. The SEC scrutinized his transactions and discovered many irregularities. Cass Cohen was engaged in insider trading, all while justifying his profits by claiming it was a result of skillful trading, which led to the regulator monitoring his transactions. The regulator claimed almost 70% success rates for his trades were based on gut feelings and insider trading. So, what was he really up to? Cohen was aware of an impending takeover of the electronics company RCA by General Electric. Anticipating a rise in RCA shares, he strategically acquired a substantial number of them. When the RCA shares indeed increased in value, he made an unexpected and successful investment, earning a profit of almost 140 crores. He boldly declared on Share Super that he had earned a profit of 140 crores, but when his skeptics asked for a verification through screenshots, he dismissed it as fake. Later, Cohen's lawmakers, who were strong in this case, received a big amount of money. However, Cohen got a clean chit in this situation, so whether he will always get a clean chit in the future remains doubtful. Moving forward, after 14 years of hard work and using insider information through his network, Cohen gradually transitioned from being a small trader to establishing himself as a prominent figure in the trading world as he was really ambitious. Despite being ambitious, his aspirations grew so much that satisfaction with millions was not enough for him. He aimed not for thousands or millions, but for billions. To achieve this, Cohen decided to open his own fund house and engage in trading. Before that, he had worked in Grantley, where he earned commissions but decided to leave. In 1992, he decided to take a leap of faith and started an electronics company named SAC Capital Advisors. The initials of the company came from his own name, Steve A. Cohen. Cohen initiated this venture with 170 crores and began fund management with a team of 9 people. They started making a mark in the fund management industry. Asset under management is a term used to describe the total market value of all the financial assets a company manages on behalf of its clients. Whenever they invested, the birth of a company's EOM, equity under management, occurred. As a result, Cohen's speed increased so rapidly that in 3 years, he raised his company's assets from 170 crores to a whopping 800 crores. Not only that, but every 2 years, SAC Capital, which was common at the time, witnessed a huge boost, reshaping the entire city market. The profits were soaring. and the new fund was on the verge of doubling. By 1999, the total capital had reached a staggering 8,000 crores, a huge jump from its initial 170 crores AUM. Cohen's company left the stock market questioning how such substantial wealth was accumulated in such a short time. The answer was simple. Cohen managed his entire venture not just with insider information, but also maintained transparency, operating seamlessly until 1999. As the story progressed, Cohen expanded his network, and with that, everything seemed to flourish. However, a twist awaited in the narrative. The era of computers had arrived, bringing with it increased transparency. Now, every detail could be monitored. People were curious about who was buying and selling, which stock was rising or falling. This transparency, facilitated by computers, prompted Cohen to question himself. He realized that to rise above normal traders, he needed to elevate his skills to a new level. He recognized that achieving such ease wouldn't be simple. It required special knowledge and the ability to decode patterns. Cohen devised specific criteria for selecting trades. For instance, if a president of a listed company stayed within the 300-meter range, you had a better chance of being selected by SAC Capital. As historical regulations diminished, Cohen decided to resign from the regulatory position. As a result, he was offered a package 4 times larger. Now, a vast network was being established, including company owners, ministers, presidents, and professionals from other big companies. Cohen had created an extensive network of traders to ensure that profit was the sole focus. By the year 2000, a new era had arrived, and by 2005 to 2006, Cohen had become a prominent figure in the world's richest individuals. His personal net worth had exceeded $10 billion. The team was doing exceptionally well, and a substantial amount of money was in circulation. Many such traders and investors making significant money were part of this phenomenon. Continuing with Cohen's journey, he started making significant moves. With abundant wealth at his disposal, he began purchasing yards, private jets, and large houses. However, Cohen's actions raised eyebrows among those who had been in the industry for a long time, and the SEC was doubtful about his capabilities from the beginning. In the middle of it all, SAC Capital faced a critical moment in 2006. A notice arrived at SAC Capital's office, alleging that Cohen had manipulated the market. The accusation was related to a stock named BioWhale, a Canadian drug manufacturing company, and Fairfax, a Canadian insurance company. Both had become subjects of insider trading. The allegations were submitted to SAC Capital, stating that false negative reports had affected the share prices and caused substantial losses to their network. The nightmarish situation escalated when the regulatory authorities kept a close watch on SAC Capital's managers. Despite the acquisition of insider information and the negative publicity, the acquisitions by SAC Capital cast a shadow of concern. Cohen was under scrutiny, and the regulatory authorities were keen on understanding how these people made money, what wrongdoings they were involved in, and whether any mental torture was being inflicted. The story took a turn when Cohen, alongside Matthew, a prominent trader at SAC Capital, took a keen interest in a drug named BAPI. It was anticipated that the release of this drug could cause havoc once it entered the market. Matthew and his team initiated discussions, and a confidential agreement was signed. The agreement ensured that all information discussed during the 2-hour phone conversation, which took place from an anonymous number, would never be publicly revealed. The situation got even more intriguing when discussions about the upcoming trials of the BAPI medicine unfolded. Dr. Matthews shared detailed information about the drug's trials, supplying Cohen with valuable insights. As the supply chain unfolded, the capital kept growing, and the astounding profit of 600 crores through long trades left everyone astonished. Matthew initially went long on this stock, but now his enthusiasm has grown even more to the extent that he considers making money by shorting the same stock. This sudden realization occurred because Matthew thought that since the drug in question had only around 50 million users, it wasn't necessary for everyone to have Sebel Plus. When information about the trial surfaced again, he shared it with the leaders, and they decided that action needed to be taken. Gradually, on July 20th, Matthew started dumping his stock and established a short position. The reality was that he already had information about BAPI's results. Through the entire short trade, he made 1,800 crores. Now, you see how extensive the quagmire of insider trading is. That's how all this information reaches insiders before it becomes public. The investigation had reached a point where the FBI is trying to figure out why and how they are involved in insider trading. In 2009, investigations into the FBI began, exposing SAC's business practices with considerable attention. This is because, for many years, no information had emerged against them. They are handling the situation aggressively this time, and serious efforts are being made to catch them. The focus is particularly on Cohen, as they have initiated full-blown employee insider trading. However, when the interviews began and regulators came in to conduct investigations, they started with junior traders. Junior traders are more vulnerable and can be easily exploited. As the investigation progressed, it eventually reached Cohen. Cohen is now being questioned by the FBI about the reasons and methods behind insider trading. In their pursuit, they've come across an individual named Jonathan Hollander, who worked on Albert Stone's, who was also associated with a supermarket chain. He constantly shared information about stock market prices, market trends, and trading strategies. Intrigued by his friend's success, an individual decided to audit monthly trades. He used to constantly inform them about all the stock market prices, what content is going on, how much material is there, what's happening, how it's going. Basically, what happened is that this man kept discussing with his friend and created some positions there. It's astonishing that he made substantial profits, around 50 to 60 crores, with the information he received before the quarterly results. When they started monthly trade audit, Cohen had created a system in his company that monthly trade orders would be internal within the company. The FBI had been instructed to keep an eye on every trade of SAC, but Cohen had not been caught yet because Cohen had created a system for himself. He did that for self-protection and asked the inside traders in his company that after the trade is over, they have to hang themselves out of time, rate it from 1 to 10, and write the complete logic in front. Whether technical analysis was applied, fundamental breakout occurred, volume breakout occurred, fundamental was applied, and so on. In this way, he had already created a predated record. He used to get a call with proof, so that if there's an investigation tomorrow, he can show that his traders did nothing. All they did was technical analysis. Now, along with the FBI, SEC was also behind him. In November 2010, a very big incident occurred. The Wall Street Journal, which is a very famous journal abroad, publishes an article that something big is going on behind the FBI. And in November 2010, a very big event happened. That something is going on behind the FBI. And now everyone thinks that the bubble is going to burst. The entire world of investigation gets caught up in this. Everywhere there is chaos, and it seems like now we're trapped, now nothing can happen. And then, in May 2011, Sydney and Dr. Matthew, who made money in the pharma company, was included in the US authorities' hit list. They smell something fishy. There's been some wrongdoing. They've been put out on the radar, and they need to be caught somehow. Information has been leaked from here in some way, and they need to be caught by any means. So, as part of the ongoing investigation, it's come to light that Matthew Maratoma, the individual involved in the pharma deal, had entered into a contract with Cohen sometime before the said activity. This suggests that prior to the decline in pharma stocks, Maratoma had likely conveyed insider information to Cohen, indicating his intention to engage in trading. But there was another contract between them, which caused Maratoma not to speak of all their inside business when he was finally caught. When Matthew Maratoma was taken into custody, he was immediately arrested because he confessed that, yes, I did insider trading, but he invoked the Fifth Amendment, seeking protection for himself, much to the surprise of those present. They had assumed that by pressuring him to implicate others, particularly mentioning Cohen in the investigation, he might receive a reduced sentence. However, they were bewildered as he steadfastly refused to name Cohen, and it appeared that his strategy was not aimed at diminishing his own punishment. Subsequently, there were rumors saying that Cohen might be covering all of his legal expenses and handling various contractual obligations. No matter what the cost, I'll cover it for you. But in August 2012, Matthew Maratoma got arrested for insider trading related to Bappy's case. Surprisingly, he never mentioned Cohen's name despite the FBI coming in. Everybody was shocked, thinking, why isn't he pointing fingers? It could help him. Investigators were also puzzled. Cohen realized that trouble could reach him any time. In 2013, he took matters into his own hands. He went to regulators and offered a hefty 3,000 crore penalty to settle his case on behalf of SAC Capital. Cohen understood playing games might not work, so he wanted a serious solution. However, the SEC didn't accept. They wanted to set an example after years of pursuit for all the fund managers worldwide, saying that if you cross us, you'll get caught eventually. The search for evidence continued. Finally, in 2008, they found an email against Cohen. Mike Steinberg, a big trader at SAC Capital, sent business figures quarterly results from his company's computer to Dell. The twist? These figures were sent before the official results, and the exact numbers were from Dell's computer. This trade made a profit of 15 crores. The SEC had the evidence, but his lawyers were given such hefty money, and Cohen's lawyers were so influential that they proved in court that Cohen only reads 10% of his emails, and he never read this email. But the SEC wanted to set a big example by revealing Cohen's inside business. Therefore, they thought, if they are successful, they will demand a bigger penalty. And they said, no, you have traded from your company, even if you're imaginary and not a culprit. A penalty of 7,000 crores is due. Basically, they wanted to somehow win this when they present such a huge number. 7,000 crores will make the opponent surrender. They thought that now he would bow down, but Cohen was not one of the losers. Nobody could do a thing against him, and he was calm and didn't even flinch. Then, to his advantage, the argument was made that he hadn't read the email, so the trade didn't happen. Not only that, he accepted the restrictions imposed on him, agreeing not to trade within that brand anymore. So, he established .72 Asset Management, and his earnings skyrocketed, surpassing what he earned from the 1990s to 2002.